Happy Friday, traders. This is Fawad Razakzada, market analyst for City Index. Today is the 31st of May 2024. So the markets are looking a little bit heavy today. Technology stocks, which have been outperforming all year, are underperforming today, causing the Nasdaq 100 to drop about 1.3% at the moment. And this is in part because of concerns over interest rates remaining high for longer. Today's core PCE data didn't change that narrative, and investors are now looking ahead to the following week when we have some key economic reports to look forward to. We have the OPEC meetings taking place on Sunday, which could cause oil prices to gap at the Asian Open. But we also have lots of important economic data and a couple of central bank meetings insofar as the Bank of Canada is concerned and the European Central Bank. Both of them, I think, are going to cut interest rates by 25 basis points, although there is some uncertainty over the Bank of Canada's rate decision, which could cause the Canadian dollar to move sharply. In terms of economic reports, then, ISM manufacturing PMI on Monday, some job market data on Tuesday, ADP is released on Wednesday, and on Thursday we have the usual unemployment claims, but the key data will be the non-farm payrolls report from the US on Friday. So this should mean that things like the Canadian dollar, the euro dollar, gold, equity, basically all the major risk asset classes will be in focus, and we could well see some significant moves. Now looking at the charts, the Nasdaq 100 is looking quite heavy because of the breakdown in technology stocks that we are seeing today. And the Nasdaq has now broken back below the previous all-time high that was hit in March at 18,466. This level is now going to be very important for as long as we hold below it. The short-term part of least resistance will be to the downside. So here we also have the 21-day exponential moving average, making it an even more interesting level. This level was already tested in the middle of the month, where we bounced from, leading to a fresh record high. But then the momentum faded, and we've now broken back below this level. So this is a short-term bearish development. Make no mistake about it. In terms of support levels to watch, or potential support levels, this is one level that may provide some support at 18,250, which is not too far from where we are at the moment. This is basically the base of the breakout earlier this month before we hit new highs. Below that, let me just tidy this up a little bit because this is an old chart. We have this high here at 17,821, which was the high from 29th of April before it gave way. So those are a couple of levels to watch on the downside should we get there. This shaded area was the high in 2021 and again in December before we broke above it, retested it in April, and we could come back for another retest of that area. The S&P 500 is also looking quite interesting. We formed this bearish engulfing candle a few weeks ago now. There was no immediate downside follow through, but at the start of this week we did see the market start to weaken, and we eventually broke below the low of that bearish engulfing candle. We've subsequently broken a couple of support areas, including the shaded region, which had been resistance in the past. And that area was retested earlier this morning before the index fell further lower. Now we are below the 21-day exponential moving average, so a potential close around current levels or lower would point to further technical selling pressure in the week ahead. In the FX space, the dollar index again tested the bullish trend line and the 200-day moving average, which held. So for now, the dollar's bullish trend still remains intact, which could provide some support for the likes of the dollar yen, which has bounced from 156.55, this level I had highlighted in a previous video, which was resistance before, turned into support. Above here we have 158, which is the high of this candle when the Bank of Japan or the Finance Ministry of Japan last intervened in the FX markets. Above that level we have 160, which is the next major level to watch on the upside should we get there. The euro dollar again failed to break out above the shaded region, which had been resistance in the past, and once again It looks like the euro dollar is refusing to break higher, which kind of makes sense if you think about it. We have the ECB rate decision coming up next week. And ahead of it, I don't think many people will be comfortable holding on to a long position going into the weekend. And given the risk-off environment we are seeing in the equity markets, which is supporting the US dollar against a number of major currencies. So for now, the euro dollar is being held back, but we could potentially see a breakout in the week ahead in the event that the ECB is going to be more hawkish than expected, or if we see significantly weaker US economic data. Now, for more market insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.